Okay, so good morning or good afternoon, depending on where you're joining us from. Welcome to this innovation workshop on day 2 of the Genesis 2021 conference. My name is Alicia Gallier, Business Development Manager at One Nucleus, and delighted to be welcoming you to this innovation workshop hosted by Mills and Reeve. So the topic for the discussion this morning is going to be around the opportunities, advantages, and challenges of listing in Asia. And the conversation is going to be led by James Fry, partner, head of life science at Mills and Reeve. So before I hand to James, just a quick word on logistics. So as you've heard, we are recording the session so that it may be featured as part of the conference on demand content. So you will have the opportunity to catch up there. In terms of Q&A, I've discussed with James, and we're very happy for you to drop that into the chat box throughout the session. James is going to be multitasking and as well as leading the discussion, keeping an eye out on the chat. However, I will be here as well in case any goes missed. So I do hope you enjoy the discussion. If you're not part of the panel, would be very grateful if you could remain muted unless it is to ask a question at the end. So with that, I'm going to disappear into the background and hand the floor to James and the panel. Thank you very much.
Yeah, thank you very much, Alicia, and thank you to One Nucleus for allowing us to run this event. So as Alicia says, we're going to be looking at the considerations for a private public company. UK biotechs looking to go public in various Asian markets, and I'm delighted to be joined today by some very experienced panelists who've been involved in a number of public offers in the UK, in Singapore, in Hong Kong, and in mainland China. So without further ado, we've got a series of questions we wanted to run through to look at the various options, look at the suitability of a UK biotech listing on the Asian markets, and then some of the challenges and logistics. But before I do that, if I just introduce the panelists. So we've got colleagues from some of our best friend law firm networks around the world. So I'm delighted to be joined by two colleagues from Fangda Law, China and Hong Kong, and Law Asia based in Singapore. So if I turn first to Josh and Armand just to introduce themselves, please, and then we'll go to Paul and Human.
Yeah, thank you, James. Yeah, hello to everyone. First, let me just give you a very short introduction of our firm. We are actually a leading PRC law firm, having office in both in mainland China and Hong Kong, and so we can advise both mainland China and Hong Kong commercial transactions. And I personally specialized in the commercial and the regulatory sectors, in regulatory aspects, legal service in life science sectors, and to cover the licensing and license of transactions and the daily regulatory matters of those early stage of biotech companies and as well as multinationals. So I will pass forward to my colleagues. Alman, he's from our Hong Kong office.
Thanks, Josh. Hi, everyone. Nice to meet you all here. So my name is Armand Lee, and I'm a partner of the Hong Kong ECM team at Founder. We have 7 partners in the Hong Kong ECM team, and we are ranked in both Chambers Guide and also Legal 500. So healthcare sector is one of our key focus. We do mainly Hong Kong IPOs and as well as all other, capital market works ranging from public takeover, listing with compliance, pre-IPO investment. So it's very, very great to have this opportunity to meet you all here and share our experiences. Thank you.
Thank you. Thank you, Josh. Thank you, Armand. You're very welcome. So if I turn to Paul and Human.
Thank you, James. And can I say it's a pleasure to be on the session with you and Law Asia.
Slightly overbid. That's not a problem because costs keep coming down.
Sorry.
So if I could ask people just to go, delegates to just go on mute. Paul, please continue.
So yes, Well, we're delighted to be on this session. Law Asia is an international law firm headquartered in Singapore. I set it up in 2010 after having worked in London and in many other cities. In the 1980s, I was at Slaughter and May, principally doing privatization, ECM, DCM, and regulatory work, and became a principal at Slaughter's. Returned to Singapore, where I come from, in the 90s, and ran the Lovells office as regional managing partner. And in the 2000s, I was senior partner Asia for Latham's, one of the big US law firms, where we had very strong healthcare practitioners and generally the next merger, that sort of transaction. Set up Law Asia, and we've been quite fortunate. I'm joined by two eminent colleagues, Human, who was ex-Allen Nobry, and Jishan, who was ex-Baker McKenzie. Jishan was an ECM partner at Baker McKenzie and Oxford educated. I was at Cambridge. And Human is US. So between us, we have three fairly senior partners who've all worked at major international firms doing significant cross-border work. We now do fund deals, enjoying working with clients that we find that there's some traction with, and so it goes from small scale clients who we help to nurture and grow to some of the bigger transactions. Last year we did the largest Southeast Asian merger of Singlife and Aviva, and currently we're working on a large IPO for a tech company that we know and have known since 2010, which is about to list at about 15 billion on NASDAQ. Human, over to you.
Human.
Yeah, good afternoon, Human Savetti. I'm a capital market specialist. I've spent about 25 years, 30 years or so in New York, London, and Singapore, doing all manners of capital market instruments, to include SGX IPOs, which I think is the subject of discussion here. As Paul said, I was previously a partner at A&O, and before that was at Warwick Harrington, and pleased to be with you.
Thank you, Human. And as a bit of a counterpoint, we're delighted to be joined by my colleague, Christian Shearsby, who's a capital markets lawyer based in the UK. Christian, do you just want to introduce yourself, please?
Well, thanks, James. As James says, I'm a capital markets lawyer here at Mills & Reeve in the UK. I sort of split my time between London, where obviously the main financial markets are, and the Cambridge office, where a lot of our issuers and early stage biotechs are based. Over the last couple of years, increasingly worked on a number of cross-border listings, including the spin out of Forbase Bio from Expedium, which was a Frankfurt listed business, brought that over to AIM earlier this year and listed that on the AIM market. And then going the other way, we took F-Star Therapeutics, which was a Cambridge-based therapeutics business, and did a reverse merger to list that on NASDAQ. So this is the sort of thing we do on a day-to-day basis. Thank you, Christian. And I think you mentioned that because this time last year, we ran a session in terms of looking at specifically at NASDAQ listings, and I suppose that remains the main draw for UK biotechs. But I think it's sort of opportunity to run this session. I've seen a number of articles looking at sort of a surge in potential Asian listings within the biotech space. So I'm keen, just as a first question, to think about markets to be considered and really just to pose the question of the panelists in terms of their own markets. Do they present a viable option for UK companies going public, and really to think about sort of why is that and what are the reasons. So perhaps if I turn to Josh and Armand first of all with a PRC Hong Kong perspective.
Yeah, I think, thanks, James. I think in terms of the PRC, it's a pretty unique capital market, not only in terms of its size, and its high valuation it will give to potential high-tech companies, as well as its unique regulatory regime. Generally speaking, I think it would be pretty challenging for those early-stage biotech to get listed in China mainland market. The reason I think there will be there could be multifold reason. First is actually the listing threshold. Generally, China has a higher standard of the listing threshold, and for the main market, for the main board market, they will require a very high threshold of the revenue and the profit. So it's quite impossible for the early stage biotech or any company in R&D stage to get listed on the main board. And a couple of years ago, China launched the innovative board for the scientific and the technology company. And we usually call it the star market. For the star market, they have a special passes for the R&D stage or life science companies. They require any company has an expected market capitals of the 1 billion RMB, and having one of its core assets pushed to the stage 2 clinical trials to get listed in the star market. But it's still quite high standard for the life science companies. And another requirement is basically we don't accept that purely foreign companies to get listed in the mainland China. And for the companies having a foreign ownership, we require the company to prove it has substantial operation or preferably has its major operations within the PRC before it can apply for getting listed in China. And the last thing I would say said is the regulatory. It's not that as certain as those more mature jurisdictions. The regulatory is and the regulation is under quite constant evolving, and also there could be hidden requirements from time to time. And just to share with you some of our recent observations. And recently, the regulator somehow feel quite concerned on those companies having having a pure licensing models, which means the company has substantially all of its core assets or pipelines put together via licensing from those third parties or multinational companies. So we have seen some cases the listing application is actually getting rejected by the regulators, which concerning that it does not have so-called sufficient innovation elements, but it's like it's all of its assets are being licensed in. There's no its own self-developed core products, and so there could be such a kind of incidents coming up in the regulatory framework from time to time, and this could also be a very key point that anyone want to having IPO in China mainland to be aware of.
Okay, that's really useful. So really high bar, and maybe we go to a bit of a compare and contrast to Hong Kong. Could you maybe just add a bit of gloss from your own market perspective?
Yeah, sure. Thanks, James. So Hong Kong definitely, I think, would be a good fundraising venue for UK life science-based companies. So we have a strong connections with China, no doubt about it. Also, we have, I think, is a very good position in terms of our geographic locations. You know, it's in the Central Asia, so there's a lot of market potential here. Also, we have a strong regulatory regime here, so that can give the investor more confidence for investing here. So just a few facts for the Hong Kong Stock Exchange. Last year, we had a fundraising size of $400 billion. And we expect, from what I heard from the stock exchange yesterday, we expect to do even better this year. And we ranked #1 in terms of the Asia biotech fundraising markets. So I think all these, gives investors and also to UK companies more confidence if you want to be listed in Hong Kong. In terms of the listing requirements, we have two standards for the biotech companies. One is the traditional one, for all the listing applicants in Hong Kong, you have to satisfy either the profit tax or revenue tax. So basically you have grown your company to a certain size that would make it, sufficient or sustainable for you to achieve a listing status. And interestingly, a couple of years ago, the Hong Kong Stock Exchange, we launched a new chapter of listing rules that's called the 18A. It's specifically designed for the biotech companies who are still at the pre-profit stage, and which means you don't have any profit, but they are primarily engaged in the R&D or maybe application for the approval for the biotech products. So you can seek listing in Hong Kong under this Chapter 18A, so that you can raise further funds to continue to support your R&D and maybe commercialization of your biotech products. So we now have two roles for the biotech companies to be listed here. Last year, we have around 30 biotech companies listed in Hong Kong. Definitely more biotech companies to be listed here this year. So yeah, I think that's a snapshot. I will go into the details for the listing requirements maybe later. Yeah.
Yes, no, we will definitely do that, and maybe turn to Singapore. I think when we spoke before on this, Paul and Human, you said that maybe you wouldn't go Singapore for a pure listing, but you may look at it as a sort of a combination of a broader package. Maybe just if you can take us through some of the thoughts there from a Singapore perspective.
Absolutely. I mean, there's been a very strong historic link between Singapore and England, and particularly between Singapore and Cambridge. Cambridge Cares and there are other Cambridge entities which had strong biotech relationships with A-Star and NRF. So when we said you may not necessarily look at Singapore for primary listing, it's, I think, because of multiples and valuations. You could potentially get higher valuations in Hong Kong. But there are other reasons why looking at things in a totality as an amalgam of factors, Singapore may make sense. The first, of course, is the certainty of regulation. The second is that more than 40% of all companies listed on the Singapore Exchange are foreign companies. So it's extremely user-friendly for a foreign company to list on the exchange. I think London is 19 or 18%, and New York is 21% foreign companies. So we have that tradition of being very open for business. The thresholds are low. For a full listing, it's market capitalization of 150 million Sing, which is about 80 million pounds. And for Catalyst, which is the second board, there's no minimum amount. You either have that market capitalization with profits for 3 years, or you have 1 year of bumper profits of 30 million Sing, the year prior to listing, in which case you don't have a minimum market capitalization, or if you're not profitable, your minimum capitalization is 300 million. So the thresholds are lower than in Hong Kong, and we've seen that companies will look at Singapore simply because they don't make the minimum requirements for Hong Kong. For a full listing, the other reasons you might think about Singapore, of course, is the whole of government approach. That is that there is a multi-agency ability to come and talk to the Singapore Exchange, to the Economic Development Board, and to Temasek, and to sound them out at no cost to yourself other than the opportunity cost of flying to Singapore. And they will tell you whether they think that there's going to be enough of interest in the product range. The healthcare sector in Singapore has got, at the moment, I think 40 listed companies with a valuation of 78 billion US, with an average PE of 34. But the smaller ones find it's the eco cluster of the major companies having a global presence, research, etc., that do give them an ability to have strategic partnerships. I think Bayer today announced that it's considering building a new plant to partner innovative biotech startups in Singapore for the development, for a cure for Parkinson's disease. And the buyer's chief executive, Werner Baumann, said, there are very few places like Singapore where we can have access to skill base, a workforce, and expertise. So I think it's that amalgam and combination that makes Singapore potentially an interesting place if you're thinking of Singapore as a first place of listing and then doing a secondary later. It's a very good pathway to go to NASDAQ. So you take the low threshold, you come in here first, you get the access to the international markets, and we can talk later, I think, about why from a sector perspective, Singapore makes sense. And then you go on to NASDAQ, because once you have a primary listing in Singapore, the compliance with NASDAQ is very simple.
That's really useful. So it's that package approach, and I think we'll come back to that in terms of some of the strategy options, and we'll, in terms of Singapore, come back to Hooman on that. But I'm keen to go to Christian just to get a bit of a counterpoint in relation to the UK first. So Christian, anything to add from a comparison perspective with what we've heard already? Hello, Christian. Have we lost Christian? I'll bring him back into the discussion. I think his screen has frozen. So maybe if we just sort of move to the next question I really had here, which is about what will drive. I think we've gone into some of this detail already, but what are some of those key factors in making that decision to list in some of these markets? So Josh, you've already mentioned that sort of that requirement for connection in terms of business operations, market, but I'm also sort of keen to think through what particular subsectors are hot as well. I think we discussed previously about sort of areas like AI, some of the innovative sort of therapeutics. So maybe just sort of think through some of those thoughts. And maybe if I turn to Hooman first in terms of Singapore, and just take us through some of those early considerations which drive the decision.
Well, I think the first thing you would probably think about if you're thinking about listing in Singapore is, as Paul alluded to, whether you see incremental value in the ecosystem as a whole, in terms of support for a life science business. Things do work unusually well in concert in Singapore, so that's a real sort of benefit. I mean, you can look at all the doing business studies and assessments and so on, and Singapore's almost always at the very top. But I think in terms of more particular considerations specific to listing, what you would think about in Singapore is the access to the wealth management apparatus and ecosystem in Singapore. It is a $2-3 trillion wealth management center, and therefore potentially quite supportive of listed securities. You would also probably think about the fact that much of your fundraising will come from secondary fundraisings after the primary. And Singapore's been particularly conducive to that. I think there are stats where that last year for every $1 of IPO funding, there were maybe $5 of secondary fundraising by listed companies. On the other side, you would also think about the fact that valuations aren't quite as robust, and that's probably driven by the fact that Singapore is more of an institutional, less of a retail market. So you don't have the same, let's say, volatility or froth, but you also have sort of more conservative valuations. Another factor you'd think about is that investors in Singapore will not be as sophisticated vis-a-vis a life sciences entity as you would find in Boston or Cambridge or London. So therefore, the types of businesses that for which it makes sense to consider a Singapore listing, life sciences business for which it makes sense to consider a Singapore listing, are those which have a fairly commercially solid story to tell. So perhaps a little bit more developed than sort of research only stage. Platform businesses tend to do well, but businesses where it is sort of it will be a jackpot or it will be bust, probably will find it a less conducive market to access for initial funding.
Okay. Armin, yeah, the Christian's back. I will bring Christian back into the discussion. So we lost you there for a few minutes, Christian. So Armin, just in terms of sort of those Hong Kong trends, are you able to overlay on those?
Yes, sure. So I think different people, want to be listed for different reasons, right? So one common reason is to raise fund. And I mentioned earlier, Hong Kong is definitely a good place, good venue for you to raise fund here. We have a very internationalized investor base here. You have investor base from China, also from US, UK. So here you can reach out to investors from different background. Also, we have a very strong relations with China. So if you are thinking about, expanding your business into China, and due to the various restrictions, like Josh mentioned, you may not be able to be listed there, you can consider Hong Kong, and that will give you a very good position for your future development expansion in this region. Also, I think, like I mentioned earlier, we're catching up for Hong Kong Stock Exchange in terms of the biotech markets. That's why a couple of years ago we have this new chapter for the biotech companies engaging mainly in R&D stage. We're trying to catch up with the US market, and we're gaining reputation here. So I can see more and more international investors willing to invest in the biotech companies listed in Hong Kong, and also that will give you kind of a reputation or recognition of the status of your company if you can gain the listing status here. So all these, I think, are good reasons if you want to be listed here. The considerations is, of course, you have to consider whether you satisfy the listing requirement, whether you're eligible to be listed here. Cost is another concern. I'm not saying, the listing fees is very high, but it all depends on which professional parties you're going to engage. But I can see listing expenses is also one of the concerns, which we can discuss later on. So all these things, I think, afterward, just how you justify the expenses by the benefits, comparing with the benefits you gain here.
Absolutely, and I wanted to sort of delve into some of those challenges in a bit later on, but maybe just bring in Josh just in terms of PRC themes. So are you able to sort of talk through some of those? We've already talked about some of the challenges. It is a high bar for the PRC capital markets, but any general themes you are seeing?
Yeah, I think the bar is incredibly high, but when you're considering the PRC market, I think you need to recognize the size, the high liquidity, and extremely higher multiples it will give to the high-tech companies. And I think this would be one of the key consideration, and you can raise the funds in a relatively higher valuation. And it's very common that for the new shares for the new share price to get doubled or tripled in the PRC market in a very short time period. I think this is the unique aspect of our market because it's not as mature as in Hong Kong or Singapore, and also it's very much driven by the individual investors. So the market is quite volatile, and the price is what the fluctuation is to a very great extent. And also I think to get the listing status in the China is also a key means to increase your credibility in the market. China is actually the world's second largest market in terms of the healthcare expenditures, in terms of its total cost. And it's when you are a listing companies, and it's what makes you easier to deal with those key stakeholders you will come across in your R&D. It would be easier to deal with the hospitals, the investigators, and the regulators, and the potential consumers. I think there would be also a major benefits to become a listing companies in China.
Yeah,
and the perception is the listing company has a better governance and the higher credibility.
Great. So we've looked at the various markets, and all with different facets and whether it's a viable option. But I'm keen to bring now Christian in and just do the counterpoint from a UK perspective. So just in terms of sort of what you've heard there, Christian, what are your reflections from a UK market perspective? You're on mute.
Thanks, James. So obviously in London, we do have the two markets, the main market of the London Stock Exchange, and then the AIM market, which is the London-based growth market. And I think between the two markets, they do offer quite a lot of the things that we've heard about, both from the sort of the higher end in China, and then the earlier stage developing businesses in Singapore. I think one of the interesting things is when you look at the number of sort of biotech and early stage life sciences companies which are listed in London. I think obviously AIM, which is a smaller market than London, has 85 or so biotechs listed on it, whereas the number on the main market is under 30. So it really shows how well aligned the AIM market is for early stage biotech companies to take their first steps into a capital market. And there's a number of reasons for that. And there's some of the things that Singapore, Hong Kong, and mainland China have touched on, but for the purposes of AIM, there is no requirement to have a trading record. And similarly, there are no minimum reflow. So that's the number of shares that are in public hands. So a lot of these biotechs that have been spun out of venture-backed or early stage PE-backed businesses, AIM really does provide a great growth market for companies to get on the market. Having said that, things that possibly AIM doesn't have is access to significant amounts of money. And I think that's one of the things we're going to look at a little bit later in the session, but the ability to move to a dual listing and really go to the likes of NASDAQ or mainland China and get access to some greater and more significant amounts of capital.
Well, maybe we can move to that now. And Paul's mentioned that in terms of using Singapore as a potential mechanism for a dual listing onto NASDAQ. So I'm keen to just explore those different paths to market. So if we're looking at a UK biotech looking to list on an Asian market, what are those options available? But also I think sort of turn into a point that Arman had made earlier. So what are some of those challenges as well of listing on one of these markets? So let's think about those different options. So whether that's IPO, reverse, listing of ADRs or a dual listing. So maybe if I turn first of all to Hooman and Paul, just to talk about Singapore and what those different options are, and then I'll turn to Arman and Josh.
Sure. Okay. Well, just to briefly go over it, the IPO route is there's a profitability and or market cap requirement, which we alluded to. There's a basic float requirement, a public float requirement, anywhere from 12 to 25%, depending on market cap. And there's a minimum shareholder number of generally 500 for an IPO. I think we'll talk about the process later on, so I won't get bogged down on that. in terms of dual listings, Singapore's got a fairly facilitative framework for it. There is a secondary listing framework under which, if the primary listing is in one of 20 something developed jurisdictions or recognized as developed by the Singapore Exchange, then SGX will accept the regulation and the disclosure and ongoing disclosure regime of the home exchange, the initial exchange, the primary exchange, and will just ask the issuer, in order to secure a dual listing in Singapore, to simply concurrently present its disclosure, make its ongoing disclosure in Singapore in English with the home disclosure. So that points to a possibility to do a relatively easy secondary listing in Singapore. As Paul mentioned, though, another potential pathway is to do an initial listing in Singapore where the entry requirements are perhaps a little bit more accessible, and the ecosystem is clearly more supportive, and then switch to a primary listing elsewhere and a secondary listing in Singapore. So that's also fairly straightforward. If you are listed on SGX, it is possible to later on apply for a primary listing on, say, NYSE or NASDAQ with a concurrent application to switch your primary to a secondary listing in Singapore. So that is an available path with relatively manageable disclosure requirements for issuers. ADRs are, GDRs are also listed in Singapore. The issuer can be listed anywhere. They are limited to accredited institutional investors, though, so retail cannot purchase GDRs. Requires an offering document with basic issuer information. No specified disclosure, just whatever institutional investors are customarily used to getting. And simultaneous release of home exchange information in Singapore. The other option would be something like a reverse merger or indeed a SPAC as of about 2 months ago. With a reverse takeover, the same market cap and profitability requirements would apply, the same float requirements would apply. There is a little bit of an exception for a reverse merger for life sciences companies, which permits a one that doesn't meet some of the sort of financial requirements of the exchange to nevertheless list on the main board if it has had recent, like less than 6 months or less than 1 year, institutional investment into the company, has a 3-year laboratory R&D record, and the primary purpose for the listing is to use the proceeds raised in Singapore for commercialization of a specific product. So that's a particular exception for life science companies. So those are some of the possibilities of which you could avail yourself.
That's really useful, Human. So in terms of Hong Kong, and is it similar in terms of those different options?
Yeah, I think for Hong Kong, I think most of us, I think we still doing the primary listing here. So a majority of us. So I mentioned earlier, we have the traditional method for listing. Also, we have the new 18A for the early stage biotech companies. And dual listing, also secondary listing, also very welcome here. Like I just did a research yesterday, we have the AIM listing company called HMED, just got listed again in Hong Kong last year. So there are a lot of leeways or maybe waivers that the Hong Kong Stock Exchange are ready to grant to those companies who also have the listing status in different jurisdictions. I think the reason behind is, in Hong Kong, while we have majority of listed company based in China, the Hong Kong Stock Exchange also would like to make Hong Kong more internationalized. So they're doing many things to make life easier for those companies based other than China, and they want to be listed here in Hong Kong, especially they already maybe listed on NASDAQ or London Stock Exchange. And in terms of our reverse takeover, or we call it backdoor listing here, I think it's more and more difficult, mostly because of the regulatory environment. Also, it's driven by some kind of, I think, political reasons. So usually people, they want to do the reverse merger or takeover. Nowadays, they change their mind. They will go straight for the primary listing or maybe secondary listing. So I would not recommend that. But TDL, I don't know why it's not very popular here, but we do have this possibility. But mostly, I think people still go for the primary listing.
Okay. Anything to add, Josh or Paul, from your perspective?
Yeah, I think from China perspective, as we discussed, it's quite difficult to get direct listing in the PRC. But we also have seen some international life science companies, including some UK-based multinationals, have incubated new companies here in China, and they channeling their pipeline to these companies, and get financed by those major Asia-based private equity funds. I think there are several key benefits by doing that. First, you get easier access to the PRC market. And the second, this can be used as the future listing vehicles in China and or as well as in Hong Kong. And the third, I think the most important is China is also a very good place to do the R&D in terms of its larger population of patients. And also because China joined the ICH in the recent years. So the data quality is getting, it's improved drastically, and it's getting increasingly recognized by the regulators in other major markets. So it can shorten the R&D process of your global development.
Okay, that's great.
Paul,
anything to add, Paul?
Yes, just from a Singapore perspective, I think just the reverse takeover route has been used by a healthcare company here, which was a little worried about minimum valuation. So it was able to get actually an agreed price, strike price. Singapore is, because of the strong rule of law, but for a number of other reasons, life sciences companies do look at Singapore as a starting point. Not just because of listing. I think what they say here is it's not just the capital, but it's then how to not just raising your initial capital, but how to turn that into smart capital. So the reasons you would think about Singapore is that you have a non-invasive press, you don't really have an animal rights lobby, so it's easier to do a lot of forms of testing. There's a variety of access to ethnicities, which you can't really get in other centers. We're probably the only center in the world where you can get the two largest global populations of India and China, and you can get blood plasma of Chinese people and Indian people to test in Singapore, as well as the Malays, Indonesia, countries like that with several hundred million. So in terms of ethnic testing, we're a really important place, which is why a number of companies have entered into research collaboration agreements with agencies here. You get a lot of government funding. There's an early stage funding agency that was recently established through the Economic Development Board. And they provide growth funding for early stage. And then that is taken on to late stage pre-IPO funding by an anchor fund, which has got 1.5 billion Singapore to disburse, which has just been announced. And the other point is that MAS, the monetary authority, defrays up to 1 million Singapore dollars of your costs as a new issuer, which is legal, accounting, etc. So it's 70% of the costs up to 1 million if your valuation is below $1 billion. And then it's twice that amount if the valuation is over $1 billion. So there are a number of reasons why Singapore is actually looked at. The other reason is the very strong IP protection. So we're certainly working with a very major international company, UK listed, that has decided to set up its major research hub for Asia to research also the China market from Singapore because of the rule of law and because of the certainty that the IP will be protected through a very robust legal system here. And they actually get grants. You also get salary defraying from the Singapore government or research scientists here. So you've got the corporate governance, you've got the whole of government approach, and you have a very flexible ethnic regime and other forms of regime testing methodology.
That's really useful. I do want to come back to corporate governance and those continuing obligations if you go down this route. But before I do that, we talked about why. We talked about the various options. So just thinking through, you've made the decision. What do you then need to be thinking about in terms of those preliminary steps and implementation? So maybe if I turn to Armand first of all from a Hong Kong perspective. So what are those really early decisions and steps to action?
I think first of all, you need to consider, what stage of your company is in your growth cycle. So whether you are, fully developed yourself, then you can fit in the traditional way of listing in Hong Kong, or you are still at the early stage so that you can qualify as the newly early stage biotech companies and the new chapter. So these are the fundamental requirements. Otherwise, you cannot fit in, and it's so save your time and cost. There's no point for you to think about listing in Hong Kong. And after that, if you are qualified within one of the ways I mentioned, I think you can also consider about the cost and also the process. So usually, I think for time frame. For Hong Kong listing, it takes like 6 months to 12 months time from the beginning stage up to the time of listing, depending on how complicated your case would be or the comments from the Hong Kong regulators. So that would be something you have to bear with. And also for costs I mentioned earlier, it all depends on whether you're going to hire the high profile law firm and underwriters, or you go for the boutique ones. So it varies. I think it can be as cheap as like maybe 4 or 5 million pounds up to over 10 million pounds. It all depends on how you structure the deal and the size of your company and your offering as well. So these are also the considerations you have to take into account. They are not very much, I think, in terms of the director's presence here or other very onerous requirements for UK-based company to be listed here. I don't think that would be, there are always ways to get a waiver or to get around this. So I don't think that would be very much a problem. But after all, as I mentioned earlier, why do you want to be listed? So that's a key question. So if you want to have a good platform for fundraising, not only at the time of IPO, but also ongoing after listing, you can still do a lot of placings here. So maybe Hong Kong is a good venue for you.
Yeah, great. And Hooman, I imagine similar sort of considerations from a Singapore perspective. Maybe just point out some of those differences or additional counterpoints you want to mention.
Sure. I mean, I think your first stop probably would be lawyers and the exchange to talk about whether what the exchange's view is and what the regulatory requirements are. I would add to that as we've been alluding to, there is kind of a Singapore acts very much in concert. So you'd probably make the rounds with a number of the other governmental actors in Singapore, whom Paul would know particularly well, including the Economic Development Board and some of the major governmental institutional investors here, Temasek and so on. So I think you do your round of the major players in the ecosystem and get a sense of what the sentiments are like. And a listing in Singapore makes sense if it's part of a larger package, a larger presence in Singapore. So I think you'd think of it in that context. and then you'd if that proves satisfactory and enticing and exciting, then you'd get into some of the sort of logistical details of implementing such a plan. As Paul alluded to, there is significant support available both for IPO and just as well as for just investment in enterprises setting up in Singapore with promising technology, particularly in life sciences, which is an area of real focus. So I think when we were chatting with some people earlier this week, they said that total investment over the last has been something on the order of 20 billion Singapore, which 10 billion, 11 billion pounds in the last 10, 15 years by the government. So this is not private investment. So there's significant government support available. So I think you'd kind of get a sense of that and whether the ecosystem as a whole is right for you. Then you think about the logistics of the IPO. Costs are going to be a little bit less in Hong Kong. So they probably at the low end, something like 2 million, maybe a little bit less than that, pounds in fees. At the high end, 8 maybe million or so pounds, give or take. Underwriting fees, I don't know what they're in Hong Kong, but in Singapore, something like 2.5 to 4.5%. And the time to market is probably on the order of 9 months. A little bit longer if you have issues, maybe a little bit less if you are particularly sleek and ready for prime time.
Right, fantastic.
I'll just chime in on two points there, if I may. One is the leapfrogging strategy, which is if you want to get collaborative partners in America or China, and because of certain sort of frictions that may exist, we are seeing American companies using the fact that they then badge and set up in Singapore as the means by which they then look at collaborations in China. And we're also seeing Chinese companies at the moment are about Chinese-owned companies from China are about 30% of the companies listed on the Singapore Exchange, who once they become here and they rebadge themselves, do find that they have easier access to other markets. So that's something. The other is the medical schools that are here. We've recently been acting for a Finnish client that came to Singapore, secured 10 research collaboration agreements here, but was able through Singapore and one of the university hospitals here to get a strategic partnership with Imperial, which then took them into access to the UK blood biobank. So that's the kind of leapfrogging strategy you do via Singapore.
Yeah. So I mean, what's coming over loud and clear is that clear strategy and driving that decision to list or operate in these jurisdictions, which I think we'll come back to. Before I do that, Christian, do you just want to come in terms of any other additional thoughts on pros and cons here?
Well, thanks, James. I think all of those structures that been discussed are all available in London on the various London markets. However, if you're UK-based biotech, I don't think there would be any reason to take an approach other than a straight listing. You'd expect that being in country with a strong development platform, you'd have a good story to sell, and there would be no need to go with an alternative approach. And that approach is very well tried and tested. From sort of initial discussions, you can be looking at probably 4 months to actually go from a standing start to getting yourself listed on the AIM market, which is a really short period of time. And the costs are significantly less than some of those we've talked around in both Hong Kong and Singapore. In terms of how you go about it, I think, as Hooman said, it's those early stage preparatory steps of talking with your board and your key shareholders and making sure that everyone is aligned and you've got a path that you're wanting to pursue to get to market. And I don't think you can overestimate the input that you can get not only from your advisors, but also from the local exchange. The London Stock Exchange are a really useful tool and guide to help you with this process. And with AIM in particular, you have this slightly unusual concept of the nomad. And there's a number of mid-cap banks and brokerage houses in London that offer the nomad service and are very experienced at helping you through the process. There's various bits and pieces that you can do to get yourself ready for an IPO, and they're probably things to be discussed on another day. But one thing I would say was don't put your eggs all in one basket. Over the last few years, we've seen IPO windows close very quickly in London, and I think that's probably the same across the world. And if you are considering an IPO, then make sure that you do have an alternative option if you are looking for an exit.
Which leads me to my last question, which is that once you're listed, is also getting a sense of those ongoing obligations. So maybe the requirements faced by a board or a management team of a UK company operating in any of these jurisdictions. So maybe just to get a summary of those now, please, from panelists. I'm conscious of time. We've got another three or so minutes. If we keep answers really quite brief. But if I turn to Josh first of all, from a PRC perspective.
Yeah, I think the ongoing monitoring of the PRC security regulator is relatively lighter than those more mature market. I think the key requirements are similar. It's the first is the disclosure, and also as well as the directors and his senior management's liability. But I think the principle is quite similar to those of the UK and the US. But I think there's a tremendous distinctions of the legal culture and the language. So I think it would be very important to consult a security lawyer first before making a decision.
Yep. Hong Kong, Arman, anything to add?
I think Hong Kong is quite similar to the UK in terms of the regulatory environment. Even the Hong Kong companies law is very similar to the UK ones. So I think for Hong Kong compliance mainly is disclosure based. So you are asked to disclose as much as you can, and then to discharge your obligations. It's getting more stringent in terms of the investigation or regulations here, but still I think overall, it's just similar to the UK ones. Yeah.
Great. Paul,
in Singapore,
I'm assuming it's similar.
Very similar. Yeah.
Yeah.
So similar to Hong Kong, you need a local director.
Yeah.
But you can get a nominee. One of your professional advisors can help with that.
Yeah. Presumably, is it local director requirements in Hong Kong and PRC as well?
The Hong Kong ones you can ask for waiver, so I think it's less stringent than the mainland ones.
Okay, wonderful, good. Well, I think we're at the end of the session, so I've brought you in on time, Alicia. I've seen you've just joined. I mean, just in terms of wrapping up, first of all, massive thanks to all of the panelists. I think that was a really wide-ranging discussion. I mean, it seems to me that there are probably sort of three things to take home. That we've got. These should all be options. They should all be on the radar in terms of future plans. And as we say in the UK, it's horses for courses as well. It's matching the business's plans with its requirements going forward, and maybe looking at the package approach which Paul was talking about. Also thinking about some of these markets as a potential dual listing onto NASDAQ or one of the other markets in the future. I think the other thing that struck me was that there's a developing environment, and also sort of an environment whereby, yes, regulation is developing, but it's all about providing a favourable business environment to UK-based biotechs. So those were sort of some of the takeaway points that I had in relation to that. But I think without further ado, if I could just thank the panelists and hand back to Alicia.
Excellent. Thank you very much, James, and to all of the panel. That was really insightful, and it just shows how valuable it is having each of the experts from the key markets on the call today providing and sharing your insights there. And I think some real food for thought, actually, for those who joined the discussion today. So thank you very much indeed for your time. It will be available as part of the on-demand. So anyone online, you can recap. And for those who didn't join also, hopefully more will view this very insightful discussion. So just to add that the next innovation workshop will be kicking off at 11:30, hosted by Collaborative Drug Discovery on a demo of their drug discovery software. So very exciting. And yeah, once again, a special thanks to James and to all of the panel online today. And please do keep partnering via the conference app and checking out the on-demand content. And we'll see you online very soon. Thanks all. Take care. Have a good day.
Thank you.
Thank you.
Thanks all.